In this video, we are going to try to understand what happens when a company tries to grow faster than its return on equity. Before we begin, there is one important assumption. This explanation assumes that the company's business economics remain stable. That means profit margins, asset turnover, and capital structure are not changing significantly. If these improve, growth capacity can improve. If they worsen, growth capacity can reduce. So, what we are discussing is structural growth under stable conditions. Now, what is ROE? Return on equity or ROE measures how much profit a company generates for every rupee of shareholder capital. If equity is 100 crore and profit is 15 crore, then ROE in this example would be 15%. This tells us the return being generated on owner's capital. This number becomes very important when we think about funding future growth. Where does growth get funded from? Any company that wants to grow needs capital. That capital can come from three sources. 1. Retained profits. 2. Debt. 3. New equity issuance. There is no fourth long-term structural source of funding. So the real question arises, are retained profits enough to support the desired growth? So here there is a concept called as sustainable growth rate. It is calculated as return on equity multiplied by retention ratio. Retention ratio means how much profit the company keeps instead of distributing as dividends. For example, if return on equity is 15% and the company retains 60% of profits, then sustainable growth rate is 9%. This means the company can grow around 9% annually without increasing debt or issuing new shares. This is internally funded growth. What if target growth is higher? Now, suppose the company wants to grow at 18%, but sustainable growth rate is only 9%. That means there is a funding gap. To support 18% growth, the company must raise additional capital. That usually means either increasing debt or issuing new equity. Structurally, growth above sustainable rate requires external funding. Why this matters? If growth is funded by debt, interest expense increases, financial risk increases, the company becomes more sensitive to downturns. If growth is funded by equity, existing shareholders get diluted, earnings per share may be impacted, ownership percentage reduces. So growth above sustainable levels always comes with trade-offs. Growth is never free. It is important to clarify something. Growth can temporarily exceed ROE multiplied by retention ratio if margins improve, asset turnover improves, working capital becomes more efficient, or new projects generate higher returns. But over long period, growth must align with capital generation capacity. Otherwise, leverage or dilution will rise. So next time you see a company growing very fast, do not look at growth percentage on an absolute basis. Ask this: if growth is higher than ROE multiplied by retention ratio, which is sustainable growth rate. If yes, external capital is funding the difference. Understanding how growth is financed is more important than celebrating growth itself. Quality of growth matters more than speed. Again, this is not an investment advice and purely for educational purpose. If you like this content, do share this with your friends and family and subscribe to my channel for more such content. Thank you.